Hi everyone, this is a screencast for Independent Colleges Dublin for P6 Advanced Taxation. And the subject matter for this particular screencast is really this area of a Irish entity trading abroad, and indeed the issue of whether or not to trade through a branch or indeed a subsidiary. Okay, so within this question, Mullins Ltd, this is on page 281 of your exam kit, you've got the sort of typical scenario where the Irish company is looking at the possibility of trading in an overseas country to really sort of avail themselves of opportunities in respect of UK-based customers. So the question really is exactly how will they do that? And the key things that you'll see per the answer when we look at it is this area of trading with or indeed trading in. In other words, being subject to foreign tax or not. And depending on the circumstances of the company, they've really got to make a decision as to what is best for them from a tax perspective. Okay, so in terms of the detail on this particular question, we're not going to deal with everything. We're just going to focus in on the foreign CT aspects. First part deals with VAT. So it's really B here. If you could have a look at the scenario perhaps before you read this or view this screencast. And the key points in the scenario here are, within the requirements, are really the circumstances in which Mullins Ltd would be subject to tax in the UK. And they've asked you to sort of make reference to one of the tax treaties. I think more often than not with this type of question, John Morrison, your examiner, is going to go for a UK company because obviously the UK tax treaty with Ireland is sort of very, very similar to the OECD model. Okay. Second point here asks you to sort of establish the company's exposure in each of the years. In other words, the circumstances change across the 3 years, 2015, 16, 17. And he wants to say, he wants you to say whether or not the company is going to be subject to foreign tax. In other words, whether or not they have a PE or a permanent establishment. Okay, then they ask you for just a bit of advice here in relation to this area of authority for the, I think, the UK salesperson. And then the last point is in relation to purely this issue of, trading through a branch or a subsidiary. Bear in mind, obviously, both are permanent establishments. Okay, so that's really the bones of the question itself. Let's take a look at the answer. Do have a good look through the scenario before you look at the answer itself and try to get a fix on it. Okay, so in terms of this part B here, as I've said, two key points really, this area of, with or in. Yeah, so what they're doing at the moment, it seems, is that they're simply just trading with the foreign country, and as a result of that, there's no foreign CT. Okay, they don't have really a sort of a close tie, close connection. They're simply trading overseas. Okay, so no foreign corporation tax in relation to that particular scenario. Okay, just draw your attention here to this sort of definition of the PE. Do look at your text and try to get a fix on what is and isn't. Could be some very, very easy marks here for simply being able to identify, whether or not particular items are permanent establishments in another country and therefore making the individual entity subject to foreign corporation tax. So, that's very much rote learning, some easy marks there, so don't miss out on those. And a point here that they make in relation to residency of the country, of the company even. Two main sides to residency. Either the company is incorporated, let's say in Ireland, and therefore it's resident in Ireland for tax purposes, and or the possibility that a company is managed and controlled. Okay, so we don't have to have both. In effect, we've got two options there. Invariably, you'll find that Irish registered companies or companies incorporated in Ireland are indeed managed and controlled. In Ireland, it may well be you have a situation where another country, i.e. UK, for example, may have some very, very similar rules. So you could end up with a situation where we have a sort of a dispute as to where the company is actually registered. Okay, so key points so far are really, this area of with or in, definition of a PE, based on those circumstances, and really tying in, what is this issue of residency? What does it mean? Okay, so move down. In terms of this permanent establishment, just know the definition there of a permanent establishment. I think easy one to remember: a fixed place of business. Okay, a fixed place of business. Now, both a branch and an office, and indeed a subsidiary, would be a permanent establishment. But watch out for things like storage, display, or facilities for delivery of goods. Clearly not. So you'll know that from your text and from your definition. Next point here they make really is in relation to the issue of authority. And one of the ways that I've described this area in classes is just really looking at a sort of a continuum, as it were. And if you look at on the left-hand side, perhaps we have an entity, an Irish entity that's trading with a foreign country. In other words, not subject to foreign CT. And right on the other side, after 4 or 5 different options, we've got a subsidiary, a company that's incorporated in the foreign country, and they're certainly subject to foreign CT. And in the middle you've sort of got degrees of it, and one of those sort of areas where the degrees are relevant is just this area of an agent or employee based in a foreign country, and really whether or not that individual has authority to sort of act on the company's behalf and really to bind them and to conclude sales contracts. So really, if that employee or agent doesn't have authority, then as far as the legislation is concerned, the entity doesn't have a PE. But if the individual does have authority to bind and to conclude contracts, then that in effect is a PE. So just watch out for that. Okay. In terms of part 2 of this particular answer, they just take you through really the 3 years and come down on either side. The first one that you'll see, 2015, they're simply trading with, therefore no PE, therefore no foreign CT. Next one, the 2016, we've got a warehouse. We also have the possibility of the UK salesperson in effect having authority. So that's sort of up in the air, as it were. It just depends on whether or not he has authority or not. Warehouse isn't overly relevant because specifically on its own that is not a PE. It's the issue of authority that's key. 2017, we've got an office, and that will, regardless of authority or otherwise, constitute a PE, and therefore foreign CT will be relevant. Okay, obviously DTR is potentially relevant too, just this idea of getting a credit for any foreign CT against the Irish corporation tax liability. Part 3 there asks you for a little bit of planning advice, and really that just focuses on the area for Mullins Ltd of not providing authority to the individual. As soon as they do, they've got a PE, therefore foreign CT, and a foreign tax regime to deal with. Maybe that might be a bit of hassle for them. Okay. Last part of this question really deals with a fairly commonly examined subject, branch or subsidiary, and bear in mind that they can come at this in quite a few different ways. And what I mean by that is, is the branch or subsidiary going to make profits or losses? What are the tax rates, etc. So you'll see listed here we've got really those 2 main factors, and you will have picked up on those, I hope, from the quiz. These two main factors for consideration for an Irish entity, really the tax rates in the foreign country. Is it higher or lower than in the state of Ireland? And then in addition to that, this area of is it going to be profitable or not? Are there going to be losses? Okay, so you'll appreciate that for a subsidiary, a low foreign rate of tax is obviously better, because the individual company is going to be subject to that rate in the foreign country for sure. Okay. In this particular case, I think they're sort of coming down the side of the fact that there's no particular sort of advantage for the entity to be set up either or, because in effect, the tax rate is higher. Both the branch and the subsidiary will be subject to UK tax, so no real advantage either way on that. So note that they've given you some information, and John Morrison is trying to assess whether or not you can advise on the basis of, well, there's not going to be an issue either way, because both the branch and the subsidiary, being PEs, are going to attract that foreign rate, and indeed there are profits anyway. Okay. In terms of losses, in a scenario where losses are expected, not in this case obviously, but in a scenario where losses are expected, a branch being a sort of sort of, if you imagine an arm extended out, really that's all it is. You've got an Irish entity with an arm extended out to the foreign country, and really as a result of that, and as a result of the tax legislation, that branch, if it makes losses, those losses can be utilized to reduce any sort of Irish corporation tax. So, if losses are in play or likely to be in play in relation to the foreign operation, then certainly a branch would be more favorable. You'll see from that second line there that it's not relevant in this case, as I said above, because it's profitable from the start. Okay, so again, here we have a nice, clear, simple recommendation. They've asked you to come down on one of their side, and really in this case, it's the same regardless, as I've said, so it doesn't matter whether or not it's a branch or a subsidiary. Okay, so hopefully that's been of some help, albeit sort of fairly quick, and let's hope that something in this area maybe comes up on exam day. Thanks very much. Bye-bye.